Hey all, welcome to ShareTrek. This is Raj here. And it seems that I've got a bit addicted to making videos because in last week I put a lot of efforts to create all the episodes for the mini series on synthetic biology. So I have recorded 4 out of the 5 remaining episodes that I wanted to do. Sorry, 3 out of the 4 remaining episodes that I wanted to do. And I've already uploaded them to YouTube and scheduled for respective Saturdays, so respective Sundays. So for tomorrow, the video is already scheduled, and for next Sunday and the Sunday after that, it's already scheduled. So today I had a bit of time in my hand, and I went out with my family, and we went for a nice breakfast and all that. And when I came back, I thought, I got some more time in hand, and let me do a video. And what better video to do than to talk about bond yields? Because yesterday I had made a video which spoke about SVB and Silvergate and how they ran into trouble because of their bond holdings. So at that point of time, I didn't go into depths about bond valuation. And I thought that it will be very interesting for you guys to hear. Many of you might already know, but those who do not know will find this very interesting because bond valuation is counterintuitive. And that's why it's a bit of a difficult concept for many to get. But there are a lot of opportunities in bonds as well. And that's what I'm going to talk about tomorrow. I'm going to do it in 2 passes. First, I'm going to explain it to you in verbatim. And then I'm going to use a table and I'm going to walk you through the table so that I can explain to you how the whole thing works. So let's get started. Welcome back, friends. Bond yields and the relationship to interest rates can be a complex topic, but the basic idea is relatively simple. A bond is a type of debt security that allows companies, governments, and other organizations to borrow money from investors. So bonds are issued by governments, the Federal Reserve, by municipalities, by provinces, and state governments, and also organizations. There are corporates which also issue bonds to borrow money from investors. When you buy a bond, you are essentially lending money to the bond issuer who promises to pay you back the principal, which is the amount that you invested, plus interest over a period of time until they return the funds back to you. The yield on a bond is the rate of return you can expect to earn if you hold the bond until it matures. Yield is usually expressed as a percentage of the bond's face value. For example, if you buy a $1,000 bond with a 5% yield, you can expect to earn $50 in interest each year until the bond matures. The relationship between bond yields and interest rates is straightforward. When interest rates go up, bond yields also tend to go up. And when interest rates go down, bond yields tend to go down. This is because the yield on a bond represents the opportunity cost of not investing in other assets that could offer higher returns. When interest rates rise, the potential return on other investments also rise, making the yield on existing bonds less attractive. As a result, the market value of existing bonds may decline. Conversely, when interest rates fall, the potential returns on other investment also decrease, making the yield on existing bonds more attractive. This can cause the market value of existing bonds to rise. It's important to note that changes in interest rates can have a significant impact on the market value of bonds. When interest rates rise, the market value of existing bonds may decline, potentially resulting in a loss of principal if the bond is sold before it matures. Here we have the concept of accrued losses and realized losses. I'm going to elaborate over it at a later time. Similarly, when interest rates fall, the market value of existing bonds may rise, potentially resulting in capital gain if the bond is sold before it matures. And I'm going to show you a table, and I'm just going to walk you through through one of the examples in the table. I'll leave the table on for a little while so that you can see it carefully. And then I'll come back and I'll just explain it with a transaction that I'm going to imagine. So here I have a table for you. In this table, I have the purchase price in this column. So a purchase price of a bond worth $1,000. We'll just take the first row and work on the first example, which is bond A. It has a coupon rate of 5%. It has a yield of 5%. And if the interest rates were to increase to 6%, then the market price of the bond, which was $1,000 when it was bought, when the coupon rate was 5%, will now will have a market value of $938. So basically the market price will go down. However, if the interest rate went down, then the current bond A becomes more attractive because it was bought when the interest rate was 5%. So whoever is holding this is going to get 1% more than what others having a bond at this point of time would get. So naturally, the purchase price of the bond increases to become 1064. And exactly how is this determined? It's determined through a formula that I have in the bottom. So let me explain the formula to you. So basically, in this example, if we look at bond A in the table, bond A has a purchase price of $1,000, a coupon rate of 5%, and a yield of 5%. If the interest rates increase by 1%, the new yield will be 6%. We can then calculate the new market price of the bond A as follows. Market price equal to coupon payment by 1 plus yield within bracket raised to 1 plus coupon payment by 1 plus yield raised to 2, and so on for the number of years that the bond is going to be valid. It's going to take before it matures. So for this particular bond, assuming that it's going to be valid for around 10 years, we'll get a new market price of around 938.15 when we solve the equation. So I wouldn't like to go into the equation, then it becomes a math class as such. But I would like to also explain this to you in a more simple terms so that you can understand. For example, if, let us say, you gave me, let me take the example of a car. For this example, we are going to assume that you bought a brand new car for, say, $50,000 from the showroom. And you just bought it home. It has been transported to your home by a tractor trailer. So the tires of the car is intact. It's got no wear and tear. It's absolutely as new as it should be in the showroom. It's got all the warranties and everything in place. And as soon as the car lands at your place, the manufacturer announces a discount of 10% in the price. So the price goes down from $50,000 for which you bought it to around, let us say $50,000, $10,000 he has decreased, so it becomes $40,000. So who is going to buy your car from you for $50,000? It's going to go for $40,000 at the best, and maybe less than $40,000 as time goes by. So you can understand this relationship because buying a car is a commonplace thing. Let's take another example. You bought a brand new iPhone for, let us say, $1,000 for argument's sake. And you just got it, you haven't even opened the box. It arrived to your house, it just reached your place. But while it's in transit, after you bought it, the manufacturer announces that going forward, instead of $1,000, that same iPhone is going to cost $900. Now, your iPhone, when it reaches home, even if you have not even opened the package, will not be worth $1,000 because nobody will be willing to pay $1,000 for it because they can get the same one from the manufacturer for $900. So now keep this thought in mind. Now replace the iPhone with a bond. You bought the bond for 1,000 rupees and you are getting a return of $50 per year at the rate of 5% interest. But now what has happened is that the new bond that is being issued has an interest rate of 6%. So why would someone pay $1,000 to buy your bond from you, which is just giving them $50 per year, whereas they could buy the bond from the issuer for $1,000 and get $60 per month in their hand? So the formula that we saw earlier tries to resolve this relationship so that you can derive the new value of the bond. Now, conversely, let us say you bought the iPhone for $900 and it is just about to land at your home and the Amazon guy comes in and he keeps that on your porch. But while it was on transit on the way home, the manufacturer announced that going forward, that same model of phone is going to cost $1,000. So even though you paid $900 for your phone, which you have not yet opened from the package, you're not going to sell it to anybody for $900. You're going to sell it for nothing less than $1,000 because anybody can get it outside at $1,000. So nobody is going to be getting it at $900. The minimum that anyone has to pay to get that phone right now is going to be $1,000 going forward. So if anyone comes and asks you for the phone, you will say that, I know I can't sell it for less than $1,000, and you can get your $1,000 despite the fact that you paid only $900 for it. So the same way, if you bought the bond for $1,000, it's giving you $50 per month interest. And right now, the new bonds that are being issued give only 4% interest. So they get only $40. So people who are looking at the new bond and then they're looking at your bond, which is giving $50 per year, they think that you have got a superior offering. So they're willing to pay a premium for the bond that you have got. And that premium is calculated by the formula that I demonstrated to you in the slide before. So that's how it works. I'll put the formula in the description just in case any of you are interested. I'll put it in there. But this is how the whole thing works. Now, coming back to the potential of future contagion in the market because of SVB and other banks going down, we are now exposed to the possibility that there may be other entities across the globe who are holding US government bonds. And as US government keeps on increasing, as the Fed keeps on increasing the interest rates, many of them are going to be under a lot of pressure. Now, for example, banks have got a statutory requirement to have a certain amount of cash in their balance sheet. Now, if they have kept it as cash equivalents as bonds in order to earn some returns, they are likely to face the strain. And if the value of the bonds that they hold goes below a particular threshold and takes their cash balances below a particular threshold, then it will trigger the requirement for them to raise extra capital in order to be meeting all the central bank requirements. So it's possible that the central bank might relax the requirements, or it's possible that the banks will end up issuing more equities in case they have exposure, a whole lot of exposure to US bonds, and the value of those bonds have fallen to a level where it's taking their cash balances and cash equivalent balances below the required minimum according to statutory regulations. And these statutory regulations are called by different names. Like in India, for example, we have got statutory liquidity ratio and cash reserve ratio. These are the two ratios preserved by the Reserve Bank of India that each bank has got to meet. And if those banks had held US bonds, then if the value of those bonds dropped, they are going to have to either recover loans and not issue more loans and keep that in reserve, or go and generate more deposits, or come out with equity issues to shore up the capital. So those are the things that could happen. Now, if you were to just zoom out and look at the globe as a whole, there are going to be a lot of entities, because US dollar is reserve currency, and because US bonds are supposed to be the gold standard. So there are many countries who have US bonds in their reserves, and there are many companies, corporates, who do keep US bonds in their reserves. And also, for example, the SVB bank example shows that there were around 40 Indian startups which had money in SVB. So those startups in India are going to have an impact because the money is gone from here. Only $250,000 of that money is insured, and the rest is as good as vaporware. So that's a problem for them. So this is one of the examples of a global impact. There could be other impacts also, because US dollar is still valued as a reserve currency, and many countries keep US dollars in their reserve. They keep US bonds in their reserves. But we have multiple strains out here. We had the Lehman Brothers, the GFC, and we also had these two banks going down, one behind the other, SVB, and then we had Silvergate. So all these things are also happening. And at the same time, in the Congress, they have not yet taken the debt ceiling issue seriously. And we have had this debt ceiling drama time and again. And for a reserve currency, this is not a good feel. And therefore, I think that there's going to be an emphasis there is going to be more emphasis on currencies like the euro, and I wouldn't say pound sterling, but the Australian dollar and New Zealand dollar, and maybe other currencies. Like they are likely to pick up the slack, and gold and Bitcoin might also get more traction in this kind of a situation, because the US dollar and the US government itself is having a difficult time. Now, I would also like to hark back to something happened back in India, because I'm an expert for India with my Indian background. So I would like to tell you what the people in India are feeling like. Just recently, I had done a video on Hindenburg and their raid on Adani Group companies. So Adani Group companies were a family-owned company with just 10% shares in float, and around 17% of extra shares which were in float were with related parties, and almost 70% of the shares were owned by Adani himself. And at that point of time, Hindenburg had come in there and they had created a lot of shorts, and they bought a lot of bad news stories. And also there was the George Soros also was involved in that, according to accounts. So the rationale at that time was that you look at this company and they got only this much of shares afloat, and they are manipulating the market, and the institutions have failed, the market has failed, and so on. But Adani Group is still functioning, and they are still continuing their infrastructure business and other businesses. So the Indians are saying, I mean, what's happening in US? Look at US itself. We have had the GFC, which had impacted the whole world. And then we had the SVB recently, and back to back we have Silvergate. And at this point of time, it's impacting so many people. And it's not like Adani Group, which has just got around 10% exposure to the retail investor. This is like a global exposure, because there are so many people so many startups across the world which had kept money there, which are going to have trouble. And there are so many countries which have put bonds in there whose value is going down. So shouldn't US be more responsible, and shouldn't Hindenburg and Soros be looking more at what's happening in US? And at that time, people were calling for resignation of the Prime Minister of India. So now the Indians are saying, why are people not calling for resignation of Biden? So these are all rhetoric which are happening because it's a tribal situation out there. But we as retail investors, if we just zoom out of all these things and look at our own situation, right? We need serious government across the globe, not just for US, but across the globe. And all the more important that US has got a serious government, serious representatives, serious senators, and a serious Federal Reserve governor, and a serious president who looks at all these things and understand the immense responsibility that rests on the US government as the issuer of reserve currency for the world, as the lender of the last resort, and as the issuer of bonds for the world, to be more acutely tuned in to the current situation and focus laser sharp on getting everything under control, and then getting our retail investors some amount of relief, I would say. Because frankly, guys, if you look at our situation in North America, we got heavy taxes as salary payers. Our taxes are deducted from the salary when we receive our salary, and we have to file returns to get our refunds. And there are limited avenue for us, whereas the top guys who are earning as businessmen, they have got a whole lot of loopholes, and their tax is not deducted in advance. They decide to show the income the way they want to show, and as a result, many of these big rich guys and rich companies are hardly paying any tax. They are paying less tax than most of us pay. So that is point number one. Point number two, before this crisis happened, our interest rates were very low. Retirees were unable to generate safe income by putting their money in fixed deposits, which is the safest, or putting it into bonds. They couldn't do that because they were hardly getting 0.25% interest. And therefore, they are forced to invest in equity shares. And when you go into equity shares, you're exposed to so much risk. And on top of it, they are looking at increasing the retirement age because they don't want to pay out the pensions and old age benefits that are due to hardworking people who have worked their entire life. And this is not a fair deal. And therefore, I think we got to look at it very, very carefully. And the US government and all of the viewers who are from US, please talk to your friends and everybody and ask them to get away from all these wedge culture issues and focus purely on good governance, and make sure that we can have a really good NASDAQ and Dow Jones and everything functioning. Because if we take the eye off the ball, and if the US dollar goes on a free fall, then all our shares and equities and everything, they're going to be in real trouble. So that's the message from me, my friends. And this brings me to an end of this video. I hope you have a great day and a great weekend. I'll catch up with you again later. Bye for now.